If you are in the job market right now, probably you have noticed something strange. The unemployment number doesn't make sense. Let me show you what I mean. Look at the historical unemployment rate. After the recession of 2007, the unemployment rate started to decline slowly. And then COVID hit us hard. The unemployment rate became second highest in history and eventually came down to average level. That's a long story and we all know what happened. But what's interesting is what's been going on since last year. In January this year, the unemployment rate was 4.3%. On the surface, that may not sound like a major crisis, like Great Depression, the recession of 2007, or what we saw during the COVID period. However, this time the unemployment situation feels different, and all of us are trying to figure out how that happened. But what if we ask a different question? Is unemployment higher than it should have been? And who is being affected the most? This is an important question because since last year, the US economy has experienced major shifts in trade policy, immigration policy, AI-related investment, government layoffs, and inflationary pressure. Each of these forces can affect hiring, but together they can change the entire labor market story. So what if we build a second version of reality? Imagine that we are still living in the old world without any major change in policy and investment pattern. Then it will be very interesting to see how the unemployment situation would look like. Before we move forward, we need to be careful about what the unemployment rate actually measures. Although this number is powerful, it is also narrow. According to the Bureau of Labor Statistics, someone is counted as unemployed only if they do not have a job, are available for work, and have actively looked for a job recently. So the headline unemployment rate is useful, but it is not the full labor market story. It doesn't consider people who stop searching. And also there is another major problem. The overall unemployment rate is an average. It combines all the groups of people into one number. So a 4.3% unemployment rate can look calm on the surface, while certain groups are feeling much more pressure underneath. Recent college graduates are one of those groups. Historically, college graduates had lower unemployment than the overall labor force. But after 2022, the scenario looks different. The entry-level labor market becomes more difficult. At the start of 2026, the New York Fed reported that labor market conditions remain challenging for recent graduates, with unemployment rate around 5.7% and underemployment around 41.5%. That is why in this video, I do not only look at the overall unemployment rate, I also look at the unemployment among recent graduates. Because if labor market is changing, the first signal may not appear in the national average. It may appear among the people who are trying to enter the labor market for the first time. Unemployment rate doesn't move for one reason. And no single framework, no matter how elegant, can capture every reason. So let me use an econometric model to explain the story with data. But it is important to know that a model is not the truth. It is a lens. And the question is whether that lens helps us to see the picture more clearly. So instead of pretending to build the perfect model, I use a practical guide. Choose data that is publicly available, economically meaningful, updated consistently over time, and connected to a clear labor market channel. That gives us 4 channels: trade policy uncertainty, AI-related infrastructure pressure, the gap between Wall Street and real production, and the last one is inflation. Let me briefly explain the reasons for selecting these variables. Firms do not only respond to today's policy, they also respond to what they think tomorrow's policy might be. If a firm doesn't know whether tariff will increase, whether supply chain will be disrupted, or whether imported inputs become more expensive, then it may delay investment, delay expansion, or slow hiring. And this is not just a theory. The uncertainty index I am using here is built from newspaper coverage, firms' earnings calls, and tariff-related information. It is designed to capture uncertainty around trade policy, and research using this index shows that higher trade policy uncertainty can reduce investment and economic activity. So in this story, trade policy uncertainty represents the wait and see channel. When uncertainty rises, firms may not immediately fire workers, but they may stop hiring first. And in the labor market, slower hiring can gradually become higher unemployment. Now I want to be very careful with the AI variable. I am not directly measuring every dollar firms spend on AI. That would be impossible to observe consistently over time. Instead, I am using data center spending as a proxy for AI related infrastructure pressure. You may ask why? Because AI is not just an app running on your screen. It needs server, it needs chips, electricity, cooling system, and many more. So when data center spending rises, it gives us a measurable footprint of the infrastructure behind the AI boom. But this proxy is not perfect. Some data centers are used for cloud computing, storage, streaming, and to fulfill ordinary business demand. So it's not a pure AI spending. I treat it as a publicly available signal of the physical infrastructure behind AI adoption. And it matters in this story because it can affect the labor market in two opposite ways. On one side, data center investment can create jobs in construction, electrical work, engineering, logistics, and operations. But on the other side, AI adoption may change the demand for entry-level white-collar jobs. That is exactly why recent graduate unemployment becomes important in this story. The third variable is what called K-shaped gap. It is the gap between the stock market and industrial production. The stock market can explain the story about expectation, valuation, and investors' optimism. Industrial production tells another story. What is actually happening in the real production side of the economy? So K-gap asks a simple question. Is Wall Street telling a more optimistic story than the real economy? If the stock market rises strongly while industrial production is weaker, then the gap may reflect a disconnect between the financial expectation and real economic activity. This doesn't mean that the stock market directly causing unemployment, but it may contain information about the macro environment firms are facing. And when the financial economy and the production economy moves in different direction, the labor market eventually feels the tension. The last variable is Consumer Price Index or CPI, indicates the price of a basket of goods and services paid by customers. And changes in CPI are commonly used to measure inflation over time. CPI is an important indicator because it affects almost every part of the labor market story. It affects household purchasing power. It affects customers' demand, business cost, and interest rate expectations. So CPI enters the model as a macroeconomic control, a way to account for the inflation environment. From here, the story becomes simple. Based on the economic conditions before 2025, we can predict the future unemployment rate. Let's call the prediction as counterfactual line. And once we have that line, the questions become very clear. What is the gap between the actual unemployment and the counterfactual? I use an autoregressive distributed lag model in an error correction framework. That sounds technical, but the intuition is simple. Unemployment has memory. It means what happened this month depends partially on what happened previous month, and it also depends on the changes in the broader economy. So the model allows unemployment to depend on its own past values and past values of the explanatory variables. The system works in three steps. Step 1. Estimate the relationship using the data before January 2025. That means the model only learns from the past. Step 2. Build the no change scenario. After January 2025, trade policy uncertainty, data center spending, and care gap are replaced with trend-based counterfactual paths. In other words, we asked what would happen if those forces had continued along their prior 2025 pattern. Step 3. Recursively simulate unemployment. Once the counterfactual period begins, the model does not use actual unemployment to help itself. Instead, it uses its own previous counterfactual predictions to predict the next month. So the new line is not just a fitted value. It is a complete alternative path, a second version of reality. And now we can compare this second version with what actually happened. Let's see the result now. The first thing to notice is that before January 2025, the model tracks the observed unemployment pattern very closely. The counterfactual is only meaningful if the model can first understand the historical relationship. In other words, before we ask the model to imagine an alternative future, we need to see whether it can explain the past reasonably well. And as we can see, the in-sample fit is very strong. meaning the model perfectly capturing the historical unemployment pattern. After January 2025, the counterfactual line is almost the same as the actual unemployment rate. The gap is negligible. So this is not a labor market collapse, nor a dramatic crash. Rather, it's a small deviation, which is reasonable. The model is simply saying, under the no change scenario, overall unemployment rate would have been almost same as what it is now. Hence, we can assume that US labor market is doing perfectly fine, right? Not exactly. Here is the big problem with the overall unemployment rate as mentioned in the beginning. It is a broad national average that brings all the groups of people. So even if some groups are facing real pressure, the overall unemployment rate may move only a little. And if the labor market is weakening eventually, the overall number may hide the group that is being hit first. New graduates are often among the first to feel the changes in the hiring condition. If companies face policy uncertainty, they may slow hiring. If firms are unsure how AI will change the workplace, they may delay the entry level recruitment. And if the real economy is not keeping up with the financial market optimism, the pressure may appear fast in the entry level job market. Now watch what happens when we run the same counterfactual logic for new graduates. The counterfactual doesn't just move slightly below the actual line, it separates and stays separated. This is the key finding. For new graduates, the actual unemployment rate is meaningfully higher than what the no change scenario predicted. This is not a tiny gap. This is much stronger signal than what we saw for national average. That means the overall unemployment rate may be hiding a more serious problem underneath. The labor market didn't break for everyone, but it became meaningfully harder for new graduates. Before closing, I want to clarify a couple of things. It's a counterfactual study, and the ARDL model in ECM framework did wonderful job. I also implemented Bayesian structural time series model, and the result was exactly same. So the findings are not model dependent. The only way we can see a small deviation of the result is by changing the variables. As I mentioned, I only use publicly available dataset with consistent observations. Even if we include some proprietary data, the story will not change. The labor market doesn't collapse for everyone, but the situation is significantly worse for new graduates. And that is the story worth paying attention to.